before the pandemic, unemployment was at a 50-year low, inflation was low and stable, and the economy was growing steadily, with no obvious imbalances threatening continued expansion. So, of course, in that sense, none of this high inflation that we see around the world now would have happened without the pandemic. The pandemic severely disrupted the economy, gave rise to risks of much more dire economic consequences than actually transpired, really. And that was thanks in part to the policy response. So to start with policy, there's no question that policy certainly supported strong demand. But in my view, you would not have seen anything like the inflation that we have seen without the pandemic effects. And those pandemic effects include both shifts in demand and also playing a role in, not solely causing, but playing a role in the supply side constraints that emerged. So as for the pandemic, it did lead directly to an extraordinary shift in demand away from in-person services and to goods. And that shift, of course, was a major contributor to inflation in goods prices, which was really the main inflation story at the very beginning when inflation broke out suddenly in March of 2021. It's worth remembering that inflation actually declined in the early stage of the pandemic and then suddenly rose up in March of 21. The pandemic also contributed to the constrained supply in a number of important ways, including a large and persistent reduction in the size of the labor force, which contributed to extremely tight labor market conditions and upward pressure on wages. Also, the turmoil in global supply chains was probably caused to some extent by pandemic-related shutdowns as well as strong demand, and particularly goods demand. I think cars are a good example. So yes, people had money and rates were low and demand for cars was strong, but also the pandemic shifted demand upward for cars because some people wanted to avoid public transportation. That amped up new demand for new and used cars. And also the shortage of semiconductors for cars emerged from pandemic-related demand shifts as well. So the bottom line for me is that there's really a role for both here, and the two are tangled up in a way that it's really not easy to disentangle.
Those of us who grew up in the 70s, I think that the danger and cost of inflation, can't be exaggerated. In September of 1979, his first testimony, a month after he was confirmed, Paul Volcker made clear he understood the damage that was being caused by inflation and the need to bring it down, even if it required great costs in other economic ways. One of the lessons of that episode was the greater the extent to which inflation slips the leash, the higher the cost and greater economic damage necessary to bring it under control. I worry whether we have the resolve to bring inflation under control today, to face the potential economic costs. I took some comfort from your recent remarks in Jackson Hole, which seemed an attempt to signal that kind of resolve. But I do remain concerned that, the intense political pressure that might be brought to bear to avoid collateral economic damage before the inflation fight is won. And I just wondered if there's any way you can help me sleep a little bit better on that score.
Sure. So I think it's worth going back and remembering, and I pointed this out in my remarks 2 weeks ago at Jackson Hole, 10 days ago, that what Paul Volcker did and the Fed did to finally get inflation under control followed several failed attempts to get inflation under control. And what had happened over the course of that long period of the great inflation is that the public had really come to think of higher inflation as the norm and to expect it to continue. And that's what made it so hard to get inflation down in that case. So it is very much our view and my view that we need to act now forthrightly, strongly, as we have been doing, and we need to keep at it until the job is done to avoid that. We think we can avoid the kind of very high social costs that Paul Volcker and the Fed had to bring into play in order to get inflation back down and set us up then for a long period of price stability. That speech, the point really there was to deliver a speech that was narrowly focused on inflation, more direct and a lot shorter than a typical Jackson Hole speech. And I thought that what was appropriate was a very, kind of concise and focused message. To your question, the message really was that the Fed has and accepts responsibility for price stability, by which we mean 2% inflation over time. That, again, to your question, the longer inflation remains well above target, the greater the risk that the public does begin to see higher inflation as the norm. And that has the capacity to really raise the costs of getting inflation down. So finally, history cautions strongly against prematurely loosening policy. I can assure you that my colleagues and I are strongly committed to this project, and we will keep at it until the job is done. I can also assure you that we never take into consideration external political considerations. You know, we are accountable to the public through Congress. That's a very fundamental, important aspect of our work. But we do not. We focus solely on the goals that Congress has given us, and that's what we're going to do here.
Shepard Smith here. Thanks for watching CNBC on YouTube.